We're ready. Thanks, guys. All right, here's our agenda. We'll frame this up. Here is where we are going. By the end of the class, you're going to feel confident in these things. So really, there's 5 things we're going to dive into, but there's really 3 things that you will feel confident in by the end of this class. So one, how to identify a condotel versus a condo. Two, how to prevent deals from falling apart because of this financing. And 3, really how to structure these properties the right way from the beginning. All right, so we're going to go these 5 places though. We're going to understand the difference, number 1, and also why it matters. Number 2, why our deals can be or have fallen apart, whether it's buyers getting cold feet, financing failures, avoidable mistakes. We're going to dive into some risks that you can identify early on in your process, in your property search, and with your client. We'll go through some red flags and how we on the lending side look at these properties through questionnaires and through reviewing the project. Then we're going to dive into some solutions and some financing structures that work. We're going to talk about non-QM, DSCR, down payments, and ownership options, like how people can purchase these, because it is so different than your regular single family or true condo or true townhome. Very different. So we're going to dive into these. And lastly, I really want you to be able, with your lender or with me, protect your brand and generate referrals from doing this business really well and excellently and becoming a master at it. Okay. So we're going there. However, some of y'all know me and have worked with me for years, or maybe we don't know each other and haven't worked together yet. So, taking 2 minutes to tell you why I care so much about what I do, then we'll get to it, I promise. I was a single mom at 19. By 22, I had 2 kids on my own. I left home at 17. I was super rebellious. Maybe there's some on the call have, been there, done that. Bad decisions. I got involved with an abusive drug addict. I also ended up, again, 2 kids by myself by the age of 22. I had no car. I slept on couches, just trying to make it, staying with people to survive. That was 20 years ago. By God's grace, He didn't leave me there. He saved me from that lifestyle and He pointed me in the right direction through the trials and through His love. Financially, I had a 502 credit score. I had no financial education. No one ever sat me down and explained to me how credit worked or how to build stability or how to create a path toward owning a home or having an investment property. I think what I needed back then was for somebody to give me a chance, for somebody not to look down on me, for somebody not to judge me because of maybe how my life appeared from the outside. I really needed someone to take the time to show me how to accomplish my goals. There really wasn't anyone doing that. So I had to figure it out on my own. I struggled. And I'm sure, I mean, we all have stories. We all have those hard things we've gone through. But I share that because I was given an opportunity. I was given an opportunity to work in mortgage. And I was given an opportunity. People showed me the way slowly, how to take care of my family, my life, and how to build a home and build that stability for them. So that's why I'm passionate about education and about caring for you and your clients, about slowing down, explaining numbers. We're stepping into people's lives at a pivotal moment, whether it's condos, homes, they have lives and finances and goals and things they've built. And I really believe that, as you step in on the real estate side and me on the lending side, we have a big opportunity to enhance their lives and to truly care about them and show them the way. I'm really passionate about this stuff too for your financial stability, for your home, for your reputation. I want to be someone you can count on in business, who's going to protect the deal for you. Again, whether it's a first-time home buyer or it's these investors with Condotels. And you deserve that. You really do. Someone that's going to look after you and your clients in these. So We'll get to it. Thanks for that. I just think it's important that y'all know I'm so passionate about truly explaining, helping, guiding, and caring for people, not just our clients, but for you as well in this. So, all right, question time. Um, Drop a one in the chat if you've ever been like either in the middle or at the end of a condo deal only to find out the bank won't finance the condo or like it's declined or having condo issues. Yep. Maybe it was a non-warrantable condo. Maybe it was a condotel. Maybe the HOA didn't qualify. Maybe it was the wrong loan program. Drop a two in the chat. Have you ever written an offer with a conventional pre-approval letter on a condo and just assumed it would work? Has that ever happened to y'all? Yep, non-warrantable. I wish y'all's name showed. That is like the funniest mistake of the whole class is that that's my name under your pictures. Yep, yep. All right, drop a three if you've ever thought it's just a condo. Like, what could go wrong? Yep, got offers. Yeah, even on the listing side, all this matters too for you too. Yeah, yeah. And then lastly, drop a four if you've ever had a lender just say like, oh, we'll deal with that later. Like, we'll just figure it out. I don't know. I hope lenders don't do that, but we've got some, right? Here's the truth. Condo tels are not just condos and they don't follow conventional lending rules. So in this space, financing drives the deal. Hey, my slides are working. Okay. All right. So I like this one. Why financing must be verified before you show a condo tel or even before you show a condo. I'm just going to read right off the screen. Condo tels do not qualify for conventional lending. So conventional meaning FHA, VA, Fannie Mae, Freddie Mac, USDA. That is your standard traditional loans. Why they don't, and this is by Fannie Mae and Freddie Mac, because they have short-term rentals, they have hotel style management, some of them. A lot of them have a front desk or they allow for daily rentals like a weekly or nightly. Some of them even have rental pooling that's required. The way that the HOA's ownership structure is, maybe it has investor heavy occupancy, meaning there's 80% of the building is all rentals. That's not allowed for Fannie Mae and Freddie Mac. Non-warrantable condo status. There are several different factors about condos that make the condo non-warrantable. Non-warrantable, not able to be approved for Fannie Mae and Freddie Mac. That's what non-warrantable means. So all of those Fannie and Freddie will not approve. So that beautiful 6% or 6.5% interest rate your client has with their 10% down conventional pre-approval letter, those don't work. They don't work on these properties. And for you, I think to be able to identify, not that you've got to grasp all of these fine details, that's why I'm a nerd. Let me do the homework and the facts and the studying on this stuff. But I think for you on your side, understanding these things to be able to guide your client from the beginning to even be able to say these things. Hey, these types of condos don't qualify for your traditional lending. We have to dive into this a little more and make sure that you are set up with the right loan, the right program, the right down payment, the right rate. All of that is important. And that's a conversation in the very beginning. That conversation should not be happening 2, 3 weeks into the contract. That's when things start to get messy, right? So this is what happens. And if you want to drop in the chat too, if like you've gone through this, but this is what happens when you go under contract on a condo tell and it doesn't qualify. 10 to 14 days in, I see this all the time. The lender realizes it's non-warrantable. File gets denied, buyer scrambles for new financing. At that point, if there's no way to save it, their appraisal money's gone, their inspection money's gone, deadlines are missed. the seller of the property and the buyer, they're frustrated. Listing agent loses confidence. Your reputation and wallet takes a hit too. And I think really like just like the slide says, and the worst part, it was all avoidable, all of it. So has that ever happened to you guys? I think kind of some of those first questions had it, but um, I've come in a lot on the end of loans where this stuff has already taken place. We can rescue it and bring it back to life, but there's a lot potentially that has been lost by that point. And a lot of times people don't want to extend and they've already lost the confidence. And even if we can get them to closing, the struggle they went through would prevent them from referring us again, right? Even if it wasn't your fault, even if it was on the lending side, it kind of tarnishes the whole thing. So again, I'm so passionate about preventing these things. And this stuff really happens all the time. And again, this isn't about blaming lenders or blaming realtors. This for us is just about knowing the structure up front because in condos, especially condotels, we're not qualifying just the buyer. We have to qualify the community. Okay. So all that stuff's so important. Okay. Check this out. So these are stats from last year. Top reasons contracts fell through in 2025. This is on a nationwide survey with real estate agents. So, and this is last year, some of the top reasons. And I want us to focus on the 23% and the 14%. 23% buyer or seller got cold feet, and 14% of those had to do with financing issues that had nothing to do with high mortgage rates. Cold feet, right, usually comes from confusion, fear, not understanding what our clients signed up for. When they're not educated, when expectations are not set properly, people get nervous and people back out. The less they know, the more nervous people are. The more educated our clients are, the less nervous, the more confident, the more clear. That's our goal. And not just on condos and condotels. This should be our goal on every single client, every single conversation. That's our job, right? It's my job to understand or to make sure they understand the financing, the down payment, the loan structures. And it's also on the real estate side, your job to make sure they understand the property, the HOA, the rental rules, their long-term vision with the property. Maybe it's rental numbers and cash flow, HOA, management fees, all of that. When we both do that well, my side and your side, people don't get cold feet. They either get confident to move forward or they know that's not for them. And either way, that's how we're serving them the right way by guiding them into the best decision, whether it's that type of property or not. Um, Something, I think with these stats too, this again, not just a condotel, this is just in general when things aren't explained up front. That's why, again, I think we should all be so passionate about education. I like to slow things down because clarity prevents these things. So if we do well educating people on the front end, we don't have to clean up the messes on the back. Um, Question. Has anyone ever closed on a condotel deal before? Drop a one in the chat. Or drop a two if you're just scared of them and you just stay away from them altogether. Drop a two. You can be honest. That's good. Good, good. Yep. I was super afraid of these 5, 6 years ago. I was like, there's no way. It's too complex. I can't do it. I don't want to mess up. I don't know enough. I don't want to sound stupid on the phone or just wreck somebody's investment and waste their money. So we are going to, here's where I'll get a little nerd brain on you. The guidelines are different, the programs are different, the buildings matter, the structure matter. So I obsess over this stuff. Don't worry, you don't necessarily have to stress or obsess over these guidelines. Let me do it. But we've actually closed in the past 5 years over 400 condos, me and my team, here locally in Myrtle Beach. So I know what to avoid. I know what works, what doesn't work. You don't have to master these guidelines we're going over, but I think it's good for you to have that understanding. So, and then really reps are going to build experience. The more you do them, the more you'll know, the more you'll become a master, and you will feel more comfortable with this. So, all right, here we go. Condotel. Just reading right from the screen. Let's define what these are. They're individually owned condo units within a building or community that operates and offers hotel-like amenities and services. Condotels offer many of the same amenities as hotels, including a front desk, reservation desk, housekeeping, pools, fitness centers, and restaurants. Here's the red flags that you as a realtor should be watching for, even without the lender saying anything. Red flags. Does it have a front desk or check-in lobby? Do they have on-site rental management programs? And by on-site, like we've got a lot in Myrtle Beach, even if the building is on the grounds or in the subdivision or community, that actually counts. Even if it's not in your building, that does make that condo property. That's a big red flag if somebody can check in on site. Like on River Oaks, there's a lot of condos in River Oaks that little building right by that, right on River Oaks Drive, that's their check-in building. That's where they do a lot of those managements and reservations. So you have to be super careful. Daily or nightly rentals advertised. I would say Google the condo property on the internet, see if it comes up as being like that you can book it on booking.com, expedia.com. Does it have a hotel star? Have y'all ever pulled up the hotels online or the condo communities online and a box comes up and says like 3-star hotel or 5-star hotel, but they're condos? That's an immediate, that's a condotel. Underwriters will do that. They will search the property and see where it's being advertised to book. Airbnb and Verbo, that is not necessarily going to mess it up. People put their condos on there all the time, so that's not specifically what they're looking for. But it's important that y'all know, even on the back end, how to be searching these things and differentiating between condos and condotels. So, and again, good news. Don't worry about, you don't have to be the financing expert on this. I handle this conversation in every discovery call that I have with our clients. The discovery calls are like my first calls with them. And once I know that they're going to be working with you and they're looking at a condo, I am going to just dive into differentiating what types of condos and what to look for and what that means for their financing because it's very different. They need to know, are they comfortable with a higher down payment? Are they comfortable with a higher monthly payment because those rates tend to be higher? And then also, it does matter as far as how we're structuring their loan and using rental income. So I'll be talking to them all about that in the beginning. So again, you don't have to memorize this stuff, but know that it is so important. These are things, next slide, these are things that you should know before you go, okay? Before you show property, before you maybe send them, if they've got favorites and they've starred them and you're gonna go out and set those appointments. Or even if you're on the listing side, look at these things because a potential offer coming in on your condo, if again, like that's just as important. You need to protect your seller that buyer has the appropriate financing set in place. And maybe the buyer's agent doesn't know how much you know, but you need to ask them and you need to tell them to talk to the lender and ensure these things because just as much on the buy side, you as the listing agent protecting your seller with offers coming in just as important. So these are the questions you should ask and find out from the HOA. Is the HOA in litigation? Are they suing someone? Is someone suing them? Are there any structural repairs going on in the community? Okay, all of that matters. If the HOA is in litigation for structural issues, 99% of the time that will be a deal breaker. The loan will not be approved. You see, I have it in bold print there. Exceptions can be granted on some of these items, but it takes longer time. It takes more homework. It takes getting information from the HOA, takes a strong borrower, but it is something that has to be looked at in detail because it may decline the whole property if these things are happening. So find out if the HOA is in litigation. And by litigation, someone slipped on the concrete, let's say, and they're suing the HOA because they broke their ankle and it was wet. And that is not looked at. Those things don't matter to us on the lending side. We're looking for litigation having to do with structural issues. Maybe it's repairs or siding or um, this one's bad, and this one's been in Myrtle Beach a good bit. I shouldn't say a good bit, but it's out there. There are wrongful death litigation suits where something awful happened in the hot tub or the pool or someone drowned. If an HOA is in litigation over a wrongful death, that will be declined because the HOA is up against an incredible amount, an unknown amount of money, and that could pull the whole HOA down. So HOA litigation, so important to know. Active repairs in the community. And it's not just on your unit. This is meaning in the whole community. Is there something going on that they're fixing? And again, that's not a deal breaker, but these things have to be brought to light in the beginning so that we can look at them and make sure that the lending will go through. Sometimes it won't. They're doing a lot of work in there. The bank doesn't want to risk putting that loan against that collateral in that situation. They want repairs to be done. Are you listing or are you looking at bullet point number 3, efficiency units? Efficiency units are different. They're less than 500 heated square feet. So this is something too, I'm sure y'all have seen this. Do you see on the listings where maybe it has like 560, as the living area, but they're actually including the balcony, like in the calculations to the outside balcony. We don't count the outside balcony as heated square feet. So sometimes you just have to differentiate how those, properties are being listed on the MLS. It could dip under 500 heated. If it does, we can do it. Most lenders cannot. However, it has to have, check it out, a built-in microwave, like screwed into the underneath of the counter, which I've had people legit go take the microwave and make it built in to the counter or underneath the cabinets for it to qualify. Or it has to have a stove top. So stove top, it can't be one of the ones you buy and like plug in. The bank needs to make sure that the buyer or whoever's in there can cook and eat, and that there is a sink outside of the bathroom. So watch for those things. If you have a listing, you need to be careful of what's available on something like that. We do have programs for that, but those are all things to be careful of. Are there timeshares in the building? That is super important because we're looking for, usually with timeshares, you have one owner that's owning all of that, like a Marriott or a Hilton or other smaller companies. Timeshares can be doable. We can do it. However, I have to know the numbers. We have to do some homework. So that's a really important question in the condo and condotel space. Also, last one to be careful of, is it a lockout unit? How many of you know what a lockout unit is or have done a lockout unit before? Yeah, good. Yeah. And I see some good questions too and like comments. Like someone saying hardest part is that they can change sometimes without notice, like a condo to a condotel. It's true. A lot of these condos, they can change statuses, like not every 90 days, but whatever's going on with the HOA and also lending, it's kind of a moving it's a moving target sometimes. That's why having a lender that knows and is up to date is so important. Um, and yes, I can send out litigation too, like information on the litigation and how that affects things, like the top 10. So, yep. Lockout units, 2 units, it's 1 unit, but there's a locked door in between, and technically you could rent out both sides. It has to have one tax map number for us to finance it as one, and we can do it. However, I've seen on the MLS some sellers list a property, they're connected, and they have it up like with 2 tax map numbers. we've got to separate it. It's two properties, it's two parcels. I mean, it's two separate. You can't blanket mortgage over that. So look for one tax map number. At the bottom, this is brand new, but if all of these things, or if some of these things are preventing the deal from going through, I just got a new condo option that I don't need any condo information at all. So this would be for a condo that's in litigation or something's completely not, financeable with the above bullet points. It is a 20% down. Here's the catch, higher rates. I want to say your typical condo rates are anywhere from, this is a good thing, I would say mid sixes to mid sevens. There's some high sevens depending on their credit score. This option would probably put them in the eights, and I don't need any information on the condo at all. And I would share that with your client. My job isn't to push them into a loan. My job is to advise them as to their options, the pros and the cons. And then my job is also to structure the deal the right way and to make sure that you and me and the client are on the same page. But just know we do have a plan B for those condos if the client is willing to pay a higher interest rate. Okay. Y'all good over there through the screen? Good. Okay. All right. Shifting lanes. We've talked about what can complicate the financing, right? That's what we just talked about. I think it's good to address all the dangers, all the problems first, so we can see and understand how like serious this is. And now here's the solutions. Here's what we can do. And again, I'm not asking you to memorize this, but the more you know, the better your client experience. And again, you're going to prevent things from happening that shouldn't, or time wasted and buyer's emotions. So this is some, it's hard to talk about everything of the loan. So I really just wanted to give you a big picture on what we can do. And again, where the financing has to be. So again, reminder, I'd probably said it 15 times. It is not an eligible property for conventional. It is not eligible for FHA. It's not for USDA. VA, if you have a buyer that is a veteran, there are some condotels listed on the VA portal that are approved, which is wild, but it's there. The VA portal is online, it's public records. You can search in VA approved condos, type it in. If you need help, let me know. I'll look it up for you. But there are some condotels that are eligible for VA financing if your veteran client is looking to live in the property. VAs for primary residence only, but there are some, which is I thought was super cool. Down payment, this is a big one. Down payment, 25% down is going to be required on all condotel programs. That's a big deal because if you have a buyer that has a 10% down letter, or they only have $30,000 looking at a $200,000 condo, and they mention to you, I've got 20,000, wait a second, they need to be educated. They're not going to have enough money even for the down payment. I do have the 20% down option. That's the new one, higher interest rates. Okay, so it's there, but there's gonna be a trade-off for that. Loan basics, I really need a 660 and above credit score. So if you're talking to someone, they have a 600 or a 500, it's not that you can deny them, but saying, listen, I know you're going to have a higher score. Let's connect you with Sarah to talk through this and make a plan to get your credit higher. Okay, we can do that. 30-year fixed options, there's ARM options, there's interest only options, there's primary residence condotels, second homes, and investment properties allowed. Okay, and on the right, this is a big deal. Big banks and online lenders, Wells Fargo, and I'm going to call them out, right? So we'll do like a sorry, not sorry. We got Rocket Mortgage, Wells Fargo, you've got Bank of America, all these big online lenders. They're typically not going to be able to do these properties. So when your client has a letter from their bank, it's not saying no, they can't, but make sure your buyer gets back with their lender and says, listen, I'm looking at condotels. I'm in a resort market looking at condos. Can you still finance me? Like double, triple check that for them. And honestly, best advice, they really need to talk to a condo expert that's good at resort market condos as a backup and possibly a first option. So that's very important when you see. Moving on, and we have a few minutes left. Qualification options. We can go full documentation, which means I use their tax returns, W-2s, pay stubs, all the common ways of qualifying, or there's some really cool DSCR programs. DSCR stands for, and it's on the screen, debt service, it's not on the screen, debt service coverage ratio. This is where we use proposed gross rental income to verify and to approve the loan. I don't need tax returns. I don't need their income. I don't even put they have a job on the application. I'm going to look at the proposed gross monthly rents on that condo. So for example, let's say I find it's 30,000 gross for the year, okay? And there's all different ways we can get these rental numbers, by the way, and I can help you with this. That's $2,500 a month, 30 grand a year proposed gross, not even with management fees, is 2,500 a month, okay? That means I'm going to look for making sure their mortgage payment does not have more than a $2,500 total payment, taxes, insurance, HOA dues, and mortgage. So is their payment $2,500 or less? You're approved. It's not that easy, but just about. Ownership. You can purchase in the name of an LLC. We can do foreign nationals. There's a lot of people that are Canadians that come here and want to purchase these. We can finance them. We can also finance for somebody that has an ITIN number, a tax ID payer number. The bottom is a little cut off on the screen, but please know that these properties more than likely need HO6 insurance on the inside when you're talking to your buyer. Even if the HOA is like, hey, we have walls in, we have to make sure that the provided walls in is what is sufficient for a mortgage. And there's a lot of condos here that they don't carry enough HO6. And I'll prep the buyer. It's usually only 700 to 1,000 a year, but it's important that they know that there's still potentially HO6 requirements. All right, now I'm going to speed it up for time. Condo questionnaires. I just wanted to show you guys, this is just a quick little snapshot example. We have to get condo questionnaires filled out for every condo loan. This is how complex they could be. There's questions after question after question. It's our way of reviewing the building. That's because we're approving the project, right? We're looking at their financial health, their budget, their reserves, their ratios, their insurance coverage. It's a big deal. That's how we determine if the condo is non-warrantable or warrantable. And I just wanted to show you this picture because I think people can throw around, oh, I need a condo questionnaire, and why don't you have that? Or why is it taking so long? We order these with the HOA once they go under contract and sign documents. And HOAs, they're super fun sometimes. They can take a couple weeks to get these back to us, and we have to review these and put them together with the appraisal and double check all of this to make sure what type of condo is it, and make sure that the HOA is suitable for financing and that they're strong. So I wanted to show you that just so you could see what that is. Another thing, and this is more just so you know for on your contracts. I'm looking in my notes, but I think it's number 6 on your purchase contract, and it says transaction costs, like assessments and capital contribution. And y'all, typically a seller, it pays those, but you have, it's negotiable. So on number 6 on your contract, when it says assessments, capital contribution, seller to pay, I've had some realtors think that that meant the condo questionnaire fee. It does not mean that. The condo questionnaire fee is anywhere between $250 and $495, and it's something we collect from the client when we order it. So just be careful when you're looking at that box saying, oh, all your condo docs are paid for by seller. This one's not part of that verbiage in your contract. So just be careful, because I'm going to say, hey, you got to pay for this. And then they were going to say, well, my realtor said I didn't have to. So I've had that happen. So just be aware of that. Okay. So I'll take a breath real quick. Um, the biggest thing, kind of in a switching gears, um, why all this stuff matters. And I'm kind of jumping ahead for time, but I want you to just think about all of those guidelines and all of those things that are so important with this financing. I just want to tell you like why I'm a nerd, right? I study these things. I don't live, breathe, and eat them, but I am obsessed about them. Guidelines, condo budgets, reviewing rental structures. Um, I obsess over the structure so that the deal doesn't fall apart. I'm a nerd because these details matter, and I want you to know that. And maybe you're a nerd like me, or just maybe like a real estate nerd, not a mortgage nerd. But all this stuff is so important, and there's so much behind just me looking at their income or their credit or their bank account. So I think that will help you as you venture into the condo market of understanding that they're complex. But if you have a good, strong lender partner that obsesses over these details, everything is going to be fine. Everything is going to be taken care of up front like it should. And I'm really a nerd in all things mortgage. But um, I think biggest thing is I just know that your brand deserves protection and that when you refer someone to us, I don't take that lightly, whether it's condos or not, single families, whatever it is. I'm kind of stepping into your reputation at that point. So I just want you guys to know how much I care about this side of it and what we do. Just to close us out, my goal is not just to close loans, it's actually to increase your referrals. Is it unreasonable to think that if you had an amazing client experience, that that person wouldn't refer you their friend or family member or someone throughout the year? When someone has an over-the-top experience, they're going to refer you somebody. Real estate's like the most common conversation. That's what I want. I want your clients to have that over-the-top experience, being educated, protected, clear on their numbers, confident in their decisions. And I don't want our deals to fall apart because we didn't structure them correctly, which makes you look really good too and really strong. That's why all this stuff matters. Um, and I think too, just to point out to close us out, a lot of this can feel overwhelming, but it's okay. And that's normal. And that's also why I'm here. I think just, again, don't expect to master this within 10 slides that we went through. Use me as a value and as an addition to your business in this space. I want to help you and I want to help you have the right conversations and set our clients up from the beginning to win and to annuitize your referrals and to build momentum in your business. We have a huge opportunity here in Myrtle Beach that we're in a resort market. So I think we should master these and do them really, really well. Lastly, this is also, most lenders, they are just by themselves in these things. I'm actually paired up with several underwriters, and we do a lot of in the discovery stage of things. I'm going to be talking about condos. We're going to be doing upfront underwriting on the condos and the loan. I will be calling the listing agent on offers to ensure they understand that this letter is strong and that the buyer is strong. We've got one phone number and email, and it connects you to me and the underwriter. And also it's humanized. I'm not like a bot, like a online AI person. It's a humanized, tailored strategy for your clients. So just big opportunity ahead, guys. Condotels aren't scary. Condos aren't scary. They're just structured differently. Complex deals, they're not risky. They're just unforgiving if they're handled casually or incorrectly. So, I think if we all want to compete in a resort market, you can't avoid these things, So I'm here to help you dive in. I dove in over 5, 6 years ago, and now I love them. And I'm here for you in your condo business. Next month, we're going to do these again. Next month, I'm going to do a quick webinar on our modern bridge loan. which is a buy before sell that removes contingencies from contracts. So many buyers have a house to sell, but you can't go under contract on a new home with it contingent. I have a program that removes the contingencies and that basically gets them into the new home as a cash buyer and bridges the gap between their new house and their old house with no payments on it. It is amazing. If you can't wait for 4 weeks to hear about it, reach out to me and I'll help you and chat with you about the program. I